Start on, I'm going to be talking actually on using a framework of how to basically sell options as well as buy options using a rule-based trading framework in Algo. So I'll just start the slides. Is my audio clear?
Very much.
Okay, great. And I just want to share my screen. So are you able to see the slides?
Yes, sir.
Yeah. So basically that's what we are going to cover. So what we will see is we will look at IV versus HV, implied volatility and historical volatility. Then we look at some idea about like how to sell options, where we'll talk about, I'll not go more into the detail of the strategies now because I think that is also covered by other speakers, but I'll just give a framework of how to sell, how to buy, sort of when to sell and buy, and how much to sell and buy, and like, how to exit these strategies with some tips on that. Then we'll look at buying options, some buying option strategies in directional. And finally, then how do we combine the non-directional and directional strategies, and some tips, I would say, or from experiences of real world that may help y'all. Right. So let's start. Okay. So what is IV? IV is nothing but the estimated volatility which the option sellers and buyers are ready to sort of pay and transact on in the market. So IV is an estimate, right? That is why the word involves implied volatility. And it's like if the Black-Scholes formula that you have for option pricing, in that it is the IV, which is the only variable which is basically not known. So it is like, always changing, you can say, because it depends on the demand and supply sort of options also, and how the traders estimate how the market is likely to move in the next 30 days. Right? So using all that data, the IV is computed. What is HV? Then, so HV is now the actual volatility which happened in the market. So
address complete phone work mostly.
HV actually is the volatility which got realized in market, right? So estimate is what we thought will happen, and what actually happened is captured in HV, the historical. So what is estimated versus what happens is not always the same, right? In fact, there will keep difference happening. Sometimes the estimate is going to be more than what actually got realized, and sometimes the realized volatility is going to be more than what the estimate was. Right. And in rare cases, it can be extreme. The differences can be extreme. So we'll just look at that shortly in a chart also. And finally, then when we get IV minus HV, we basically get a spread, which is going to be either positive or negative. So when IV is greater than HV, we will get basically a positive spread. And when IV is lower than HV, we'll get a negative spread. So let's just look at that. Just look at some tools. So this is basically a plot of Nifty for about 3-4 years, right? This is on a tool Obstra. You can see the plots here. So this purple line here is basically the IV, right? Where you can see the values are ranging, say, 18 to 20 normally. Sometimes it can go to extreme, very, very high value. Like right in the crash of COVID, that is the spike you see here, the IV went to about 9,500, right? And then it has again reverted back, and it is right now in the region of about, say, 25. Now, one of the nature of IV is that it is mean reverting. So what it does not mean always is that if IV goes up, we expect it will come down immediately, or if it goes down, it will come up immediately. It can remain, trending sort of for a while, right? Like how we saw here, IV shot up a lot, and then IV sometimes is low, and it has remained low for a while. Okay, but basically, essentially, the IV will tend to come to mean revert. It's not like a stock price, which is going to say generally keep going up, or an index which over a period of time will keep going up. And then on the green line here that you see is basically nothing but the historical vol, or the actual volatility which got realized in the market. And so you can see that it is mostly going to be up or down compared close to the IV, but at some times it will also spike a lot, right? And like especially you can see this COVID period where after the IV, when IV spiked, even the HV spiked, then IV started cooling off, and then HV also started cooling off. But for quite a while, the HV was actually much more than the IV. So the actual volatility in market was much more. And the red line is nothing but the difference of the IV minus the HV. So sometimes you see the spread is basically like, here when IV was, IV RV spread is around 46, then here it goes to 100. Then at sometimes you'll see the spread is negative, right? It is minus 22, minus 30, and things like that. Right now, the spread is minus 10. So it is a negative. Uh, Below this, you see another thing called IV percentile. So IV, whilst is a standalone number, it can range from, it can be anything, right? Like it can go to 100, 200 also. Like GameStop thing had happened last year where, there was a big short squeeze in GameStop. You might remember a GME. The IVs had actually gone to about 1,000 in that stock. So IV can go anywhere. It is unbounded. But how do we use it then? So basically we can take the IV on a range scale of 0 to 100 and normalize it. So if we do that, we'll get IV between 0 to 100. So if you see here in this bottom panel, IVP is basically 60, 70, 100, or it will be 0 at the lowest. But most of the time, it's going to be, say, between 20 to 70. Or something 20, 25 to 50 or 60. Actually, maybe rare cases it will go up. So what we are doing now is that 100 IVP means that the IV currently is the highest in the last whatever period we are checking this for, let's say 250 days. Okay. IVP of 0 basically means the IV is lowest in the last 250 days. Right? So just a number, IVP tells where the IV is in relation to its historical data, but the IVP, the IV can be any number, right? But the IVP will always be between 0 to 100. So we'll see how this actually now will help us to simplify the life when we build the rules. Right. So Okay. So basically now, how are we going to use this? So if the IV is, we are just going to make some categories like if IV is too low, too high, or range bound. So if it is less than 20, let us say, then it is too low. If it is greater than 70, then it is say too high. And between 20 to 70, let us say, is range bound. These numbers can change, like you can have 20, 25 instead of 20, or instead of 70, you can have 60 or something based on your comfort, or even 50. It depends on you. But let us say that we are right now saying below 20 is too low, above 70 is too high, and between 20 to 70 is range bound. So how will we now basically use this to write options? So we can now simply check first whether IVP is range bound. So that means it is between the 25 to 70, let's say in our case. If it is range bound, right, then what we are going to do, we are going to sell a at the money straddle with 100% quantity. So because IVP is now range bound, we are going to do full 100% quantity of what we want to trade in the selling. Okay. What if IVP is not range bound, right? So it is very low or very high, right? In that case, what we do, we will do half our quantity, half our normal quantity. Okay? Because in an extremely low as well as an extremely high environment, it may be that the risk becomes higher and things may not go well in our favor. If the historical wall is significantly more than the IV, then the selling strategies may not may not be profitable, or maybe slightly profitable, but the risk for doing that may not be worth. So after we sell the straddles based on 50% or 100%, whatever it is, depending on the IVP, at the same time, we will buy the wings for protection. So we're going to buy a strangle that is going to protect our short trade, because selling options involves risk where if the market goes unidirectionally up or down, the options will tend to lose more than normal. So we'll buy wings along with also the black swan protection can also give us margin reduction benefits, but primarily we are buying it for a black swan kind of protection. So what are the strategies that now we can do in the exit of these iron flags once we short them? So there are two ways how we exit. One is where we put an exit based on a stop loss. So let's say if there is a stop loss of 40%. So basically if we sold a straddle at say 400 rupees for Nifty straddle on a Friday, and the stop loss is, let us say, 30% of that, for example. So then basically it's 120 rupees of premium, which is the stop loss. So if the straddle becomes from 400 to 520, that is the time it is going to stop out. That is one way. The other way to also exit the trade is that if the market goes say up, right, then the call options will lose money, will be losing money. So basically book out of the call leg totally. So square off the short call and the wing of that which we had bought. So let us say example, we sold the 17,2000 call and put, the straddle, and we have bought 500 points up and down wings. So we have bought the 17,700 and we have bought the 16,700, right? 17,700 and 16,700. Now, if the market goes up, right, and by a certain percentage, then the call will be losing, let us say 20%, 30%, whatever similar type of stop loss in percentage. Get out of the call leg and also get out of the wing of that. So now the direction, now the strategy has turned into short put, which we have, and we have holding a long put for the hedge. So, but basically we have become somewhat directional. So now we are expecting that, I mean, we'll make money if the market continues to go up or even probably remains there and the put decays. Right? So these both ways can be used to have an exit in the strategy. Okay, now that was for say the non-directional strategies. Now I'm giving you an example. You can then use various types of strategies there in non-directional, whatever you use. So whether you use some calendar spreads or you use any type of strategies. I'm using an example of Ironfly here because that's what we majorly use. But you can think of this to use any kind of writing you do. You may have to change the IVP rules according to your framework, whatever. But this is something which is tested and which is working for us. Now, in the directional other part, we can have some directional strategies, right, which we are running. So how can be a framework for one of the strategy like that? So this is on Nifty directional on hourly candle. So let us say the RSI of 13 period is above 50 and the RSI 5 period is above 70. So we are using a 2 RSI here, dual RSI. If these conditions are met, so we are basically using the RSI 13 as a trend line. That is, it's above 50, then it's bullish, below 50 is bearish. And when the RSI 5, the shorter term RSI goes above 70, that means there is likely to be momentum right now. So we can go bullish. So we will buy a at the money call. Now, what if these conditions are not met on the RSI? Then you just wait for conditions to be met. So this is very important in trading. Most of the time, if we are anticipating or jumping on trying to get signals, which is probably the most, you can say, eventually it can be very, very damaging to your PNL and capital. So once you have tested a rule-based framework and if you're trading on algos, always wait for the signal and wait for the conditions to be met. So once our conditions are met and we go long ATM call, now what do we have to check for the exit? So basically, if the RSI 5, which was above 70, goes below 55 now, then you exit the long call. That means the momentum that was built up shortly has now probably come off. So exit that. And what if the RSI 5 is not going below 55? What if it stays up? Then we just hold the position. So we are going to stay in the trade till as long as it is working in our favor or likely to work in our favor. Okay. So this kind of system will generally be an average holding of just 1 day. I mean, most of the time it will get out within a day, but few of the winning trades may run up for 3-4 days, like till the weekly expiry. And this is one example of a directional strategy. So again, here you can use different types of strategies, right? So when I move on later part of the session where we'll be explaining a little bit about how we combine these, I can talk a little bit about 1-2 more ideas, but basically you can use a template like this or strategy like this to trade a direction. Or you could have any other indicator based systems of yours, like it could be a trending system, momenting system on maybe ADX, maybe RSI, or maybe like moving averages and donkey and channel or any kind of system. But this is an idea for how do we trade a directional strategy. Okay. So now that we basically have an idea about the non-directional strategies, a framework or rule, as well as for directional strategies, how will we combine all this and how to allocate capital? This is also extremely important because a lot of the final return that we make will be dependent on how we execute this, how well we execute, and how we allocate the money. So here also we have an algorithm or a template. So basically, in the non-directional, we'll be using maximum up to 70% of the capital as margin. So it's maximum, right? So not all the time we'll be using that 70%. It depends on the conditions and depends on the opportunities. So we may sometimes use as low as 20-25%. At the peak, we may use probably 70%. So on average, we may use 50, say 50, 45, 50% of the capital as margin. Then in directional, we use about say 15% of capital, where we are going to be using that to maximum. Again, this is maximum because if you're using multiple strategies there, maximum we'll use up to 15% capital to buy options and deploy PM. So this is also usually it will be like 4-5% we may be using. Average, I mean, in a lower side, in an average, we might use 7-8% of capital. But if all the condition, all the strategies are giving signals and everything is full, maximum we may go up to 15% of the capital. And then remaining 15% we keep for drawdowns or buffer. Like, so when the strategies are probably going through a phase where it is a drawdown, that's where you need to have capital to uh, sustain the drawdowns and basically bear through the drawdowns, right? So to do all this together, to do all these strategies together, we basically say, let's say there is a recommended capital of 20 lakhs. So where we can do 3 or 4 strategies mixture. If the capital goes up to, ideally to actually trade all the varieties of strategy in the baskets, probably a capital of 50 lakhs is required to trade about say 8-9 different option strategies across the indices. And this can be used for both Nifty and Bank Nifty. So the more, obviously the higher the capital, the more the amount of strategies we can do. And why is it recommended to do more strategies? It's something like very simple concept of a cricket team. So if we take a good team, like maybe the Indian team is a good cricket team, but do you see all the players are basically going to perform all the time? Like, will it be every day that, a player will come and perform well in every match? That's not going to happen. So every player will go through a phase where he or she goes through a phase where it's either moderate performance or even bad performance, right? You can say the player's getting out on very low score or even duck in rare cases, right? So does it mean that player is a bad player? Not at all, right? It's basically a good player, but who's having a phase right now which is not great. So when you have different players, all with different types of skills and different types of you can say expertise, each play, I mean, together as a team, when the other is not doing well, one of the other players may do well, right? So then you tend to basically do well at a team level. Very similarly, if you think of your strategies like a portfolio of strategies, which is like a team, then you want that portfolio to do generally better, even if at some point some strategy may not be doing well, especially the directional strategies. So the directional strategies are generally going to have win rates of 35, 40, 45% probably at max. So those strategies will generally go through phases where they are of time wise also going through drawdown, or they may be losing less or be flat. So to complement those directional strategies, the non-directional strategies together can basically minimize the chance of drawdown at that points. And when the directional strategies pay off or they perform, they can really increase the return at the portfolio level and bring the you can say the average return towards its median target return of what you're looking for in the portfolio. But to do that, your directional strategy has to survive through the drawdown, and that is why the non-directional strategies and the directional strategies combo helps a lot. So now that you basically have these various ideas also about capital allocation, what are some of the suggestions or recommendations which we have seen how you can improvise or maximize your chance of success in this? It's one obvious thing is that algorithms are, there's no kind of guaranteed return or something that if an algorithm has done something in the past, it will do exactly the same in the future. But the future may, if you've tested well and if your idea is basically sound, and it may be simple but it is sound, then when you run a basket of strategies, the chance of that working together increases and the chance of the survival increases, right? However, you have to keep reviewing it time also. So we'll see that. So how much should you deploy? Only deploy as much capital that if your drawdown is hit, right, that it does not alter your lifestyle. So let us say there is a 20 lakh recommended capital. 20 lakh capital you decide to choose, and the drawdown on that is 15%, which is say, and drawdowns that has been seen in the past can also be like nearly 1.5 time to 2 time of what you've seen in the past and future. So let us say the historical drawdown was 10% on that, and you estimate that 15% can come, right? 10 into 1.5. So basically, then that means about 3 lakhs can be the drawdown on 20 lakhs. So the amount for you to deploy or choose, many times people ask how much should I deploy or choose or put in algo. So I think a template which you can basically use for most people is that if that is 3 lakh rupees on 20 lakh, and it does not sort of affect your lifestyle or cause you any discomfort to extent where it causes panic or stress, and then that is the right size for you, right? So that is the amount of capital you may want to deploy. Very important, which many people don't pay too much attention to initially, is the execution. So idea to ho gaya na, we have got an idea, right? It's a great idea, but the results will finally depend on how well they are executed. So you want to have this hosted, say, on a cloud server where basically you have full uptime of internet, you have basically no issues of power failure and things like that, because you get nearly 99.9% uptime. And in fact, in Amazon free tier, there is also quite a lot of these basic algos can run on a 1 year free tier of Amazon as well. But if you're then finding it to be slowing down, or you're doing more strategies, or scaling up, or doing more high speed strategies, or increasing the quantity of size, and you want some execution algos kind of thing, then you can go for a higher end server and pay according to as per use. Also, you want a good data feed and a good API. So you'll be seeing some of the brokers, providers, vendors who are talking about how they are providing APIs and focusing on providing good APIs, and that is very important, because you want to have a stable API with good documentation and good data feeds, and also that the chance of your algo going down and that time is minimal. It will still happen. So it will never be 100% smooth journey where everything is always great. But if you've chosen the broker well, then most of the time, at least, it should run smoothly. It's like 95% of the time, plane is auto flying by itself. Like the whole, all the controls, everything are all set, and the plane is sort of the on automatic, cruise control. It's only that probably 5-10% of time it is the pilot intervenes and will make some changes if something is not right, like the weather is not good, or some extremely harsh weather conditions or something like that. So similarly, if you've chosen a good broker, good infrastructure, most of the time you have to just do a job of pilot, is watch it. Only if something goes wrong 5-10% time, you will need to intervene. We need to intervene. Very important also is to have a minimum horizon of at least 12 to 18 months. We have seen many people just start and expect that immediately in the first week, first quarter, half month or 1 month, the strategy should start performing. Well, you'll be really lucky if that happens, and it's good, no harm in that. But we have seen that you want to have a minimum 12 to 18-month horizon, at least for strategies to play out. So there is one client who has been running these from June 2020. So it is almost like now 19-20 months, and with zero intervention nearly. It's like they just allocated a sum of money, which is maybe not very high, medium sum for him, which is exactly as per that if the drawdown hits, it's not going to affect his lifestyle. He's deployed that and sticking to that consistently. This includes non-directional and directional strategies. And this client's performance is basically, far better, far outstanding, because it's completely is allowed all the algos to, play out the way they have been designed to play. So past is shown something, but future will not be exactly same, but it may be similar. So you have to give it time to play out. And if it makes money earlier, you're lucky, well, then good, you have a buffer built. But When you're starting, be ready and be prepared that this may happen, right? So keep that minimum horizon. Now, how can we also diversify along with using investments kind of approach and algo? So 50% of the capital can come through margin, which can be via either say Nifty Bs, gold Bs, or liquid Bs. Right? Now, depending on what you're comfortable with, if you take Nifty, then obviously it has some volatility, more volatility, and but the return can be a little higher. If you take gold, it'll be little lesser, maybe volatility, return maybe probably as there was a chart I was just seeing that day, Nifty and gold over a period of time has given the same return over a, in gold in INR terms. Because in gold in INR MCX, you also have the Indian rupee built in because it's the international gold into the USD INR price. So whatever you choose based on your comfort, right? Or you could do 25% Nifty, 25% gold, whatever your comfort. Or if you don't want to take that any kind of more volatility, then it can be just put like in a liquid Bs or liquid fund where the return is much lower, obviously even lower than what a FD rate is. But it's not that the money is lying idle, and it's probably going to minimize somewhat in the costs as well as like trading costs, slippages, whatever. Some part of that can be minimized by liquid. And finally, most important is it's not that this is build, so just build and forget it. When I got into algo initially, I thought it's like something going to be. I saw this photograph of person is just sitting on the beach and the computer is running on its own. To some extent, after a while, you can expect some sort of setup where things are running automatic, but it's never like completely. You don't have to look at it. So time to time, you have to keep looking at it. So you may want to keep improvising and updating your strategies as well as adding new strategies, because strategies also have a shelf life. So no strategy that is built is just going to run the same way forever. Right? So whatever we run, it kind of keeps updating. You have to keep improvising it. And extremely important is also to track performance. So if the drawdown is going beyond comfort level or beyond normal, you may want to pause once and review it. So this is like a cycle or I would say a template or algorithm of how you can keep running this so that you want to maximize your chances of basically succeeding. Okay, so I'll just show basically some more details on one of our algorithm, which is algokinetic, right? So this is basically the site for that, algokinetic. So what this algorithm, what you see here is basically a historical chart as well as a live chart. So again, here you will see the average annualized return, let us say, of combining some non-directional and directional strategies is roughly say about 34% annualized, which is significantly high, I would say, than the index. And then what most of your mutual funds, PMSs and all would give. And you can see the max historical drawdown is about 9%. Now, this is a live launch date where the algorithm has gone live. Now, some caveats here and points to say this average annual return, whatever shows 34%, is a historical. So in real world, there are issues or challenges where the performance may depend on things like how well you're executing, whether that account is consistently funded well, was there any issues with margin shortfall at any time, because if you're taking margin against stocks and if some margin shortfall happened or anything. But basically, as long as the algo is running consistently well, I think this real world return will be lower than this, but it will not be too much different from this. If there are more execution issues, the real world return can be more different than what it is showing here. The other thing is on the drawdown. So here it shows max historical drawdown 9, But in real world, again, due to issues, maybe missing any good trade or profitable trade, this can, or the algos not behaving the way it has behaved in past, there may be more period where there's drawdown, right? So this can go up, it will go up usually. So always prepare for at least 1.5 time, of what it has shown in the historical, right? Nevertheless, I think the client who I was telling you, who has run it from June 2020 without interruption, is up roughly about 30% annualized, with a drawdown of around 14-15% on the capital. So it's almost like a 2:1. Here you will see something like 3.5:1 or something. You may be lucky. Yeah, there are, when people who just started here, they actually got a nearly a 3-4:1 reward risk for a while, and then it averaged out. But on the longer term, if you're doing this in a robust, disciplined manner, well capitalized, and continuously reviewing, you can expect that in real world you will get around 2.5 times reward to risk ratios, which I think is also fantastic. I mean, it's significantly better than investing in index or things like that. And I'm sure there'll be other speakers you'll hear who talk about this and explain this as well. So this is integrated with about 25 plus brokers. There is over about 100 crores deployed across brokers and platform, and about more than 500 people have been using this solution. Right. So it has, I think I've spoken mostly, but it has benefits of non-directional and directional. So it can kind of adapt to sideways as well as trending markets. So, most of the users really have given a lot of positive feedback about it. And, this is a 4-minute video, you can watch later probably about how it works and, how the logistics works. So how it can be linked into sort of your trading account. Okay, these are some of the testimonials, what the, people have given. And what you can do, if you want to know more about it, you can just click this deploy button, which will basically take you to this screen here. So you can just fill in your name, email with your message and your number that you would wish to know more or deploy. And somebody from our team will contact you to give you more information. So this is not a promo for Kinetic. I mean, if you are interested, you could, you could reach out and we'll be happy to talk to you. But basically, the key point I'm trying to make is that if you use an approach like a framework that we sort of discussed, you may be able to get a much more smoother equity curve than running purely directional strategies, or purely, I would say non-directional strategies can also be reasonably smooth, but then the alpha there more or less can be a little limited. So using non-directional along with some directional element can increase the returns and can increase the risk adjusted returns. Right. So this is sort of right. So this is about it. And it can be used by individual investors, traders, family offices, prop desks, brokers. This can be white labeled by brokers, authorized persons. F can white label the solution. And again, finally, the performance depends on execution, how well you tweak, and there is no sort of implying of like guaranteed returns or anything like that. It comes with its own share of risks and reward. And you should deploy or do this only after understanding that and do it well. So that, I think, completes my presentation. If there are any questions we could take.
Yeah, I guess we have quite a few questions, and I also request the audience to please feed in your questions in the Q&A section, the tab, and not in the comment section. However, so you can look at the both and start addressing.
Should I start taking some of them?
Yes, sir. Please go ahead.
So Pawan has a question. Is it hourly RSI? Yes, Pawan, that's right. This is hourly RSI. It's going to be on 1 hour RSI. Okay, so some people are asking about the non-directional again. Okay, I'll just repeat. So non-directional, what we are doing is we are basically doing a Ironfly, let me just explain it with a tool. Probably I have 5-10 minutes. So then, if since quite a few people are asking, let me just explain with a tool. So let us say that we'll build this trade. I'm just using Quants app architect to do this. So let's say Nifty option, 17,300 call, we are going to sell. Okay, let us say this is at the money. Okay, we'll see that this has got a risk which is unlimited. As the market starts going up, the risk keeps increasing, the loss can keep increasing, and market goes up, and gain is capped to say the premium received, right, which is around 5-6,000. So along with the call short, we'll add a put short. So we'll go short on the put. So this is what it gives, a tent-like structure. So now if the market remains between this range, right, then we can expect to make money. It will be range. We have sold this totally for 220 rupees around. So from 17,300, the break evens are, let us say, 220 on the upside and 220 on the downside. So 17,520 and 17,080, let us say. That's the range. However, the risk with this is that if market goes up too much or down too much beyond our range, right, then we'll tend to lose money. And the loss can be significantly more than the gain also that we are making. So one bad trade, let us say, right, like one trade can really hurt the gains of a lot of trades. Right? It can also involve in some way, if you're not professional and not understanding how to manage this risk, it can lead to blow up. It can at some point or the other. It may not happen for 1, 2, 3 years, but if not done properly and not done with tight risk control, it can lead to blow up. And as a conservative trader, I would say, end of the day, all this algo and everything, whatever we do, whatever we are doing, we are basically risk managers. So we are, whatever method you use, whether it is technical, fundamental, it is AI ML based, or it is very simple classical tech, end of the day, over your algorithmic rule, we have to have a risk management layer and a risk management, that is the supreme rule, under which all the techniques or all the strategies come. So to curtail risk, how do we do? We can just buy a strangle, right? So I'll just buy on the upside to protect. I will buy a call to save myself if the market goes up. So along with the say 17,300 call, I will buy a 17,800 call option. Okay, it's low premium, but it's a little insurance. I'm paying a little bit of insurance, right? And it also gives margin reduction, because now you can see after a point, the risk is capped, the loss is capped, right? You can see that it stops at 13,000-14,000 rupees. In real world, it will actually not even, because we are not going to mostly hold till expiry, it will not hit 14,000 rupees also. Market goes up, the loss will be much lower. Also, what we're going to do is protect ourselves now on the downside. So I added 500 points up. I'll add a trade of 500 point down. So 16,800. Okay, 16,800 put option. I'm just going to buy for 13 rupees. Add. Now you see that both sides we are protected. So even if the market falls or even if it rallies beyond a point, our loss is curbed at 15,000 max, right? And our gain is around 9,000 max. Obviously, again, this max gain also is idealistic. You don't want to wait till that max gain. If you're earning, say, certain percentage, 60, 70%, 50%, whatever, of the premium. Right? So basically, if you're earning 4, 5, 6,000, whatever, you book out generally. You may not want to wait and till the last, it's like you're trying to squeeze that theta, another drop. Don't try to wait till to squeeze the last drop, because end of the day, as a writer, you always have that risk of the market rallying, and you may tend to lose that gain that you made. So this is basically the idea of a non-directional trade, which is also called a iron butterfly. I hope that is helpful. So, are there any more questions? Let us see. Okay, somebody had asked about the directional again, Mohan. So, Mohan, directional is like use one system of RSI. Where I just explained you can use a 5 RSI and a 13 RSI. If the 5 RSI is above 70 and the 13 RSI is above 50, you can buy. Likewise, for the shorting side, if the 5 RSI is below 30 and the 13 RSI, what we typically use 13 or 14 period is below 50, then you can short. That is the entry rule. So for going long, RSI 5 above 70, RSI 13 above 50. How do you exit the long? If the RSI 5, which is just going below the, just going below the 55, you exit. So let me just try to quickly, I think I have 5 more minutes. So I will just try to show this also. So let's see. Let's just go to Nifty. I'm just taking Nifty futures as an example. Okay, we'll go to the hourly chart. And I'll just remove the existing indicators, whatever. So let me just plot what I said. So we'll go to RSI. The RSI I'll make it 13 period. So now this RSI 13, just forget the SMA of this. This RSI value is, RSI 13 should be above 50 for a long trade. Okay, the RSI 13 should be above 50. Now along with this, we'll plot another RSI. So I will just use, actually I can just use the RSI index again. So this we are going to make it as RSI 5. Okay, you just make this as RSI 5, and then when that is basically above 70, and at the same time the RSI 13 is above 50, you take a long trade. And when the RSI 5, for exit, you don't have to look at RSI 13, just look at RSI 5, and that goes below 55, you get out of the long. Same way when in a short trade, if the RSI goes above say 45 or something, you get out of the short. And this again, you can use in certain cases, only long only also if you want. Just use the long only of this if you're not comfortable with shorting. But if you're testing and finding the short also comfortable, then you can go with that also. But otherwise, just use the long. It works pretty well on Nifty and Bank Nifty. So yeah, I think, okay. I think that kind of, I think concludes. There are no more questions. So if there are any more, you can like just reach out to me through my portal I've given. It's vivekgadodia.com. That's my name, Vivek, VIVKGADODIA.com. And there is a contact point there. You can just like contact, or you can follow on Twitter. I'm pretty active there. So my handle is @TechnoVestor. I've given it in the front slide also. You can follow me and probably DM me there or something.